Okay, welcome everybody to yet another Barrier Breakers series of training. I hope you and your families are all keeping safe from this COVID-19. We are committed to your success and want to see all you new traders succeed. I basically decided to do this training because I've heard of a few new people experimenting with lot sizes and blowing their accounts and not even understanding why. Some of you struggle with understanding PIPs, LOTs, etc., those basic concepts. So today I'd just like to look at the basics of becoming a successful Forex trader by using proper risk management. Very important, guys. Pay attention to this. But specifically understanding the importance of lot sizes and understanding PIPs. My name is Stephen Hall, and I will be your presenter for this training series. A successful trader's primary focus is not the amount of money that they can win, but rather how much are they prepared to lose or risk. If you focus on that, that will help your trading, guys. Most of us want to see, okay, we can go after this amount of profit, but no. Focus on how much you are prepared to risk, because trading at the end of the day is very risky. Please understand that it's very risky. When we can accept the fact that nobody, no human being can basically predict how the market is going to go. Only God, the God of Abraham, Isaac, and Jacob, only he can 100% predict the direction that price will go in any given Forex market at any period. Once we accept that we cannot predict it, then we will accept these facts. Even the most successful traders lose trades. Everybody loses trades. Understand that. You will lose trades. Okay? You have to accept that. That is the truth. Accept it. You will lose trades. So that's the nature of trading. That's why it's risky. Everybody loses. But what you want to do is to become a successful trader. The idea is to win far more trades than you lose. So in the end, if you have a higher win-to-loss ratio in a given week or month or whatever time period it is that you are evaluating, then you are a profitable trader. So you want to increase that win-loss ratio. To be a successful and profitable trader, you have to minimize the amount of losses on trades as much as possible by disciplining, I should have put that word in red, disciplining yourself to use proper risk management. Not sometime, but all the time, guys, before entering all trades, not some, all trades. You must use proper risk management, okay? Failure to do that is just like gambling. That's just plain gambling, okay? Some of the main areas of risk management, I'm just going to cover some main areas. The one I'm focusing on for this training is number one, which is lot size. All right? Your lot size is a lot, the size of a lot that you set when you're entering a trade. That is the size lot you decide to purchase in a trade. In my opinion, this is the most important form of risk management that a trader needs to do consistently and to pay close attention to consistently so as not to blow their account to smithereens and to remain profitable in this trading game. So lot size is very important. That's what this training is going to focus on. Let me just mention a couple more. The next one is broker leverage. Now, this is not one you see every day when you're trading. This one you typically see when you're signing up for your broker account. So the leverage dictates how much money the broker will allow you to control in the market, okay? The higher the leverage, the less money you need in your trading account to control more money in the Forex market. So higher leverage can lead to magnified gains on winning trades, of course, and conversely, magnified losses on losing trades. So here are some examples of some common leverage offered by brokers. These are not all the different leverages, but these are just some common ones. 50 to 1, 100 to 1, 200, 300, 500 to 1. For example, 100 to 1, which is really a 1% leverage, means that the broker will allow you to control up to $100 in the market for every $1 that you have in your account. So if you have $1 in your account, you can control up to $100. With that same 100 to 1 leverage, if you have $100 in your account, it will allow you to control up to $10,000 in the market. And with $1,000 in your trading account, you can control up to $100,000. That's the power of leverage. That's what the broker gives you. Okay, that's the power that the broker gives you to tap in as a retail trader into the Forex market. So you don't need a lot of money to enter a Forex market because of the leverage that the broker gives you. So you will select this leverage when you are initially signing up for your account. Now, because of the high risk associated with high leverage, brokers in the USA are typically not allowed to offer their clients an excess of 50 to 1 or 2%, right? So if you reside in the US, you may have to find an offshore broker that offers more if you want more. And not all of them accept US clients, but that's how it is. The third risk management that I'm going to mention is trading confluences, which are trading tools, algorithms, indicators, as you might have all heard of, that helps in attempting to predict the direction that a market is going in, or likely, whether price is likely to go up or down. Since no one confluence or indicator is 100% accurate, you get a more as accurate as can be prediction when multiple confluences are used to confirm the direction that price is likely to move in. So if you can get 3 or more confluences lining up and pointing in that direction, the same direction that price is likely to move in, then you could say that it's highly probable that price will move in that direction. So that would be probably a good indicator to take a trade. Some examples of confluences include like the candlestick patterns. You guys can study candlestick patterns. I won't go into them, but like your hammerhead, your shooting star, your engulfing candles, all of those are popular. And your doji candles, your dragonfly doji, your graveyard doji, all of these are popular candlestick patterns that have meaning that you can actually study. Don't get confused by that. I'm just browsing over this. You have support and resistance. Your areas of support and resistance are also confluences. Your moving averages. You have Fibonacci retracement tool, trend lines. All of those are examples of trading confluences. So these are also things that will help you to manage risk as you take your trades. You have the risk to reward evaluation, which basically before you enter a trade, you ought to really look at how much you are risking versus how much you are going after to win. So basically that is risk to reward evaluation. You don't want to go after a lot of risk for small profits. That's basically what that one is saying. This one is also important. I'll mention this one for sure. Trading with a stop loss. Now, this is certainly one solid way to minimize and control your trade losses. A stop loss, very important. What a stop loss is that it sets an automatic exit price for your trade should the trade go against you. Some professional traders choose not to trade with a stop loss and to watch their trades. However, it is strongly advised that you use a stop loss when trading. Certainly, as a new trader, one ought to use a stop loss in your trades every time. When you get more experience and you know what you're doing, if you decide not to use one, then that's up to you. But certainly, as a new trader, please utilize your stop losses. Okay? So let's focus on understanding the basics of lot sizes. It is quite simple, okay? In Forex, we trade on the movement of currency prices, okay, which are measured in PIPS. So when we trade for PIPS, we trade to win PIPS, okay? PIPS is what we typically go after in the market. When we lose, we also lose pips. Okay? A pip is practically the smallest amount that a currency pair can move by. I say practically because there's such a thing as a pipette, which is a fraction of a pip. It is 1/10 of a pip, but it's not really considered in measuring price movement because it's so small. It's a fraction of a pip. A pipette is mostly applicable, or only applicable for forex brokers that quote their currency prices in 5 digits of decimal. Okay, 5 digits of decimal, and the pipette appears as the 5th decimal digit typically, or the 3rd decimal digit in the case of the JPY pair, JPY Japanese pair. So any currency pair that have the JPY in it, those are quoted typically with 3 places of decimal. The others, like the other major and minor currencies, are typically quoted in with 5 decimal places or 5 digits. All right. Quite a few of the brokers nowadays quote prices using 5 places of decimal, except for the JPY pairs, as I just mentioned, which they use 3. All right. So once your broker does that, right, then the general rule is to drop the last digit, which is the pipette. So the 5th digit is the pipette. You drop that off when you're calculating your pip movement, all right, because that value is insignificant. It's too small. All right. Now, note, this applies to the LQD FX broker that most of you in the Barrier Breakers trading group uses, right? And it applies to the Forex majors and minor pairs. That's what I was mentioning before. All right, let's look at an example. Currency pair Euro, JPY, Japanese yen. Let's say the price moved over the last 2 hours from 1.22504 to 122.982. You would drop off the 3rd decimal value, the pipette, to calculate the pip value movement as follows. So it'd be 122.98, we'll get rid of the 2, minus 122.50, get rid of the 4, equals 0.48. But we don't really consider the decimal here for the movement. So the movement from 50 to 98 represents an upward price movement of 48 pips. 48. We don't regard the decimal here. So we remove the decimal point, all right? So when price moves from 122 that to that, it's a movement of 48 pips, all right? Second example, wanted to understand this. So same Euro Japanese currency pair, the price moved from 122.504 up to 124.234. We're going to do the same thing again. We're going to drop off the last digit, which is a pipette, 4 in both cases. So it's 124.23 minus 122.50 equal 1.73. You know what we're going to do. We're going to get rid of the decimal point. So it's an upward movement of 173 pips, okay? This price movement represents 173 pips, all right? And of course, again, we remove the decimal point. Third example now. Now, this example is with a currency pair that has 5 places of decimal. So the USD Canadian pair moved from this price to this price, all right? So what we do is we drop the last figure, which is the pipette. So it's 1.3381. We drop the 4 minus 1.3134. Drop the 6. We get what? 0.0247 or 247 pips. This was a downward movement, guys. This price is lower than this price, so it's a downward price movement of 247 pips. We get rid of the decimal point. You get the drift. I'm sure you understand it now. So that's pretty simple, all right? So let's have a visual of how pip movement look on a chart. So this is what? This is a little clipping from a chart. Just to give you an overview. This is the New Zealand Swiss franc. That's what this means up here. And the 8-4 means it's a 4-hour chart, okay? So what that means is that every candlestick on this chart represents 4 hours, okay, of trading activity in the market. So let's look at this particular candle here that the arrow is pointing on, this long red candle here. This represents a 4-hour block of time, right? Price moved from here all the way down to here for 4 hours, right? Where this white line is will tell us the price when the candle started. So at the beginning of this time, price was at 0.6899955, okay? At the end of 4 hours, the price moved down to here, 6.68466. So basically, price moved downwards because it started from here and moved all the way down to here. It started at this price here, 0.68955, and ended up going down to 0.68466. When you subtract this and drop off the pipette value, which is the last value, right here, we end up with 49 pips. So what we can say happened in this 4-hour time period, the New Zealand Swiss franc currency pair moved downwards by 49 pips over this 4-hour period here. That's what it means, okay? So that gives you a more practical illustration of pip movement and exactly how it looks when you look at a candlestick chart. So now that you understand what a pip is and how to calculate the price movement by dropping off the pipette and doing your respective subtraction, now that you know how to do that and how to look at the movement of a currency pair in pips, you now need to understand how to calculate the monetary value of a pip, because we're all in this game to make money. So going after pips is wonderful, but you need to understand how the pips translate into dollars, okay? So let me quickly jump over to the notepad and give you an illustration of this, okay? All right, where's my notepad? I think that's it. All right, so let's look at this. All right, here we got some lot sizes, right? So first lot we're looking at, lot size 0.01. All right, now lot sizes are basically, well, for the most part, not all of them, 2 places of decimal. So let's say this is the first lot size, 0.01. Okay. Next lot size we're going to look at is 0.02. All right, and it goes up. Lot size 0.03, 0.04, 0.05, okay? And it goes up and it goes up, 0.06, 7, 8, 9. Then the next lot size, of course, is going to be 0.1, okay? So we have 0.1, put a little space between that. And then the next lot size that we have in line after that is 0.2. You get the drift. You have, I don't want to go through all of them, but 0.3, 0.4, 0.5, and it goes on. You get the drift. 0.9, and then we're going to end up, of course, with the next size being 1. Okay? Put a little space between that as well. So after lot size 1, what do you think going to come next? 2, right? So you have lot size 2, 3, 4, and it goes on. I'm going to stop at 5. Okay? I'm stopping at 5. All right? So these are some different common lot sizes that we can look at. Now I want to tell you something. Lot sizes typically comes in 3 major categories, okay? So here we go. Let me tell you what this one is. A lot size of 0.01, guys, is what we call a micro. It's a micro lot, okay? So when you hear people talk about a micro lot, that's what that is. This one, 0.1 is a mini lot. And then when you get to 1, lot size 1, what we refer to here is a standard lot, okay? So 0.01 is a micro lot, 0.1 is a mini lot, and a lot size of 1 is a standard lot, okay? So these are the lot sizes. Don't confuse your brain with the names. I'm just letting you be aware of this. All right, so these are lot sizes. Let's see how we convert them into dollar value when you work with your PIP, right? Okay. So when you take a lot size of 0.01, which is a micro lot, how do we convert that to dollars? Okay. All you do is a very simple rule. Just multiply the lot size by 10. Okay, which will move the decimal point one place to the right. So when you multiply it by 10, this is what you get. You're gonna get convert into dollars now, right? So we're gonna put the dollar sign. So we are going to get 0.1. All right, so that is not 1 cent, because if it were 1 cent, it would be 0.01. This would have been 1 cent if we just converted that to dollars or to money. Now that you multiply by 10 and you move the decimal point, you have 0.1, add a 0 to the end to make it look like money. And what you have is 10 cents. So a lot size of 0.01 is saying that it's equivalent to 10 cents per PIP. Okay, per PIP. That is what it means. So what you're saying is when you enter a trade with a lot size of 0.01, immediately you move the decimal point to the right by 1, and you have your dollar value per PIP. All right, so follow me with the next one now. So of course, this one is going to be equal to, move the decimal point, 0.20. That's 20 cents per PIP. You get the idea. This one is going to be 30 cents per PIP, right? 40 cents, 50 cents, 60 cents, you get the idea. I'm not going to do all of them because you're all bright people and you get the idea. The last one down here is what? 90 cents per PIP. So when you enter a lot size, a trade with a lot size of 0.09, every PIP that you win 90 cents. Every PIP you lose 90 cents too. So that's how it converts the money. Let's jump now into the mini lots. What I also need to mention is if you enter a lot size of 0.09, people would commonly say you bought 9 micro lots, okay? So this is 1 micro lot, this is 2, 3, 4, 5, 6, 7, 9 micro lots, okay? Mini lots, same principle. You multiply by 10. So what you find is that this one, people love these, the mini lots, because the mini lot is now moving into dollars. So this one is equal to $1, okay? When you move the decimal point 1 place to the right, this one is $2 per PIP. And I'm jumping right to the bottom again, because you're all very bright, $9. So in the mini lot, if you took a lot size of 0.9 or 0.9, it would be said that you bought 9 mini lots, and 9 mini lots is going to translate to $9 per PIP. Okay, per PIP. All right, now the standard lot, people like to play around with this. You leave this, you don't play with this, guys. This is what blow your account. I mean, these can blow your account as well, but the standard lot, same rule. You multiply by 10. What happens when you multiply by 10? A lot size of 1, a standard lot, is equivalent to 1 times 10, $10 per PIP. Okay. Same thing with the second one. Lot size 2 is equal to all of $20 per PIP. All right. And the last one, of course, is $50 per PIP. All right. You get that. I don't have to type it. So this is basically how you convert your PIP values to money. Okay, guys. Let's jump back over. I'm sure that would have quite simply explained that for you. So let's look back at it now. So just to show you guys, if we go back here, looking at this movement here, right? 49 pips was the movement for 4 hours. If you had jumped into a trade, well, look at the example here. This is the lot size that the person had entered rather. or not necessarily, but this is the available lot size if you decided to enter a sell or a buy trade. What is this from what we just discussed? If the lot size is 0.1, right, this would be a, who can guess? This would be a mini lot. You multiply it by 10 and it becomes 1.0. That's $1. So if we were using this lot size here, as you see in the graphics, and you entered a sell trade, at this point, price moved down by 49 pips. You would have won how much? $1 times 49. That would have been $49 that you would have won on this trade. Okay? If you entered a buy trade, so you're trading for it to go up, but it went down, you would have lost. Well, it depends on where your stop loss is, but you get the idea. I just want you to understand how much the lot size convert to money. So $49 is what you'd have won. Okay? We didn't talk about a stop loss in this trade here. So depending on where you had set your stop loss, then that would determine how much times $1 you would have lost. Okay? Let's jump right back to where we were. So this is just a recap. 0.01 is equal to 10 cents per pip. And this is a micro lot. Okay? Increments of that would be multiple micro lots. So 0.04 would be 4 micro lots, and that would be equal to 40 cents. You get the idea. A mini lot, same principle, but it's 0.1, which is $1 per pip. A standard lot is 1, which is $10 per pip. All right, so you're okay with that. Now that you all have a clear understanding on how pips and lots work, let's finally get to the meat of the matter of this entire training, and that is how to use the most important form of risk management, your lot size. Okay? And you want to know how to use your lot size to minimize the effects of your losses and to position yourself to being a successful and profitable trader. Okay, guys? Let's go through this quickly. Here's an example. So you plan to enter a trade to buy the Australian US dollar pair at a current market price of 0.716, You plan to exit the trade at a stop loss price of this. If the price goes down and not up as you anticipate, right? So you have to put a stop loss in case the trade goes down because it's a buy trade. So you're counting on price to go up. You're entering at this price, so you set a price below that price to exit at as your stop loss, right? If price goes up in your favor, then we set a price higher than your your entry price, which is this price, and that is what we call your take profit price, right? So you're going to take profit at this price if the trade goes up. You're going to exit the trade at this price with a loss if it goes down, and this is your entry price. All right? Let's say you have $100 in your trading account. How much are you prepared to risk? Remember, that is the question you got to ask yourself. You have to decide, but it is not advisable to risk more than 2 to 5% of your trading capital, okay? Do not risk more than 2 to 5%. Ideally, 2 to 3%, okay, guys? Pay attention to that. The first step in tackling our example, you have to decide on the maximum amount you are willing to lose on this trade if it goes against you, okay? Your risk. I personally choose not to lose more than 4%. Yes, I know I just told you 2 to 5%, but ideally 2 to 3%. But do as I say and not as I do. 4 is my lucky number. It might not be yours, but 4 is my lucky number. I was born on the 4th of the month. My mother was born on the 4th of the month. My grandmother lived at number 44. I live at number 4. There are a lot of 4s in my life. 4 is my lucky number, okay? If it's not yours, work with the 2 to 3%, all right? All right, you choose. For this example, I'll choose 4%. Step number 2, having decided how much you are prepared to lose, right? You need to determine your respective lot size to manage that 4% risk. To do this, you must know what price, that's based on your technical analysis and confluences that we saw above, you are going to exit the market at. if the trade takes a loss, if the trade loses or goes against you. So that would basically be your stop loss value. Please note, if you are using the Tradera or any other trade alert or trade signals, then all the technical analysis of the trade has already been done for you, and they would have indicated it with a stop loss. As I mentioned before, this would be a stop loss value that you choose to exit the trade at and minimize your loss. All right? So the whole idea, guys, is that when you set your stop loss and you calculate your risk, so your stop loss will exit and you won't lose more than you plan to risk, you already know beforehand if your trade fail, how much you're going to lose. It will be no surprise. And if you win, you know how much you're going to win. But most importantly, focus on your risk. If your trade lose, you know how much you're going to lose, all right? So this is a sample of what a trade alert looks like, right? So in this sample of the trade alert, the stop loss price is where you'd put your stop loss, right? So this is a stop loss figure that they give you. They enter a sell trade. So they enter the sell trade, they put a higher value for the stop loss. So if price goes here, it will exit, and you have the different take profit figures for a profit, right? So we strongly advise that you trade with a stop loss, guys, all right? So this is the price at which you would exit. If you are an expert trader, in which case you probably wouldn't be watching this video, and you decide not to use stop loss, so you'd manually exit your trade at the stop loss price that you get from the trade alert, okay? All right, next, let's get back to our example. So step 3 would be to calculate the difference between the price you enter the trade at and your planned exit price or stop loss in the event the trade goes against you. So your market execution price is the price that you actually enter the trade at, which was this above. Stop loss is this price. Therefore, the PIP movement from your buy price that you enter the market at to your stop loss price, you subtract both of them. We're going to drop off the last value, the PIP, which you already know. You get 0.0032, which is 32 pips, which means that your stop loss is 32 pips away from your entry price where you enter the trade, enter the market at, right? Therefore, since you're willing to lose 32 pips on this trade, if it goes south, then the question to now ask yourself is, what lot size do I need so that 32 pips is less than or equal to 4? Because remember, you don't want to lose more than $4. So if you're taking a trade alert, you're doing this trade manually, then you'd have worked out. But what you're going to do is you have determined whether it be from your own analysis that you're going to go down no more than 32 pips, or whether it's information from a trade alert. What you basically want to do is you want to work out the value. Okay? So since you're not willing to lose, since you are willing, to lose 32 pips on this trade, if it goes south, then the question now to ask yourself is what lot size. What you're basically trying to work out is the lot size that would match up with 32 pips, since that's how deep your stop loss is going to be, so that you won't lose more than your $4, which is your risk, or actually my risk, because I was the one who chose 4%. All right, 4% of 100, my trading capital is $4. All right, so let's see how we work that backwards. So the PIP value times 32 is equal to $4, okay? The PIP value times 32 is equal to $4. That's what we're prepared to lose. The PIP value is therefore equal to $4 divided by the 32 pips, okay? So the PIP value is equal to 0.125. That's the PIP dollar value, right? Remember, your lot size, you multiply your lot size by 10 to basically get your PIP dollar value. So we're going to do the reverse now. We now have the PIP dollar value, so we're going to divide it by 10 to get your lot size. So therefore, the lot size is going to be equal to 0.0125. But guess what? I told you before that lot sizes are only calculated or only in 2 places of decimal. So we're going to drop the 25. And that means that your lot size is effectively 0.01, which is a micro lot. That's how you work out the size lot that you need to enter the trade at, so as not to lose more than $4 because your stop loss is going to be set at 32 pips below. Okay, you understand that? If for argument's sake this was 1.52, and you're probably wondering if you should round it off and bring it to 2, you don't do that. Lot sizes are so sensitive, you just throw away the last 2 digits and work with this figure right here, the second decimal figure. All right, so you'd have taken a lot size of 0.01 for this trade, because that will prevent you from losing more than your planned risk of $4. All right, here are the possible trade results. If the price hit your stop loss at this price, then you lost the trade. 32 pips times this, remember your lot size, you multiply it back by 10, it's 10 cents per pip. So it would be 10 cents times 32, based off your lot size, you'd have lost $3.20 off that trade if you lost. If the price hit your take profit price at this, then you would have won the trade. When we subtract your entry price from your take profit price, it would have moved 64 pips. 64 times your lot size in pip dollar value, which is 10 cents, would be $6.40. So if you won that trade, you'd have won $6.40. If you lost, you'd have lost $3.20. Okay? So in summary, you would have either won $6.40 or lost $3.20 based on your lot size of that. $3.20 is a little less than 4%, or $4, which was your risk. If you keep trading like this, not necessarily with these figures and lots, but if you keep this risk management in the forefront of your brain, you will always control and know your losses, right? So having lost that trade, if you did, losing $3.20 out of 100 is not bad. Your new account balance is $96.80. You can rebound from that, okay? All right, scenario number 2. Let's go through this quickly. Using the same example above, right? Suppose you had used a lot size of 0.1 instead, which is a mini lot. Then the dollar value per pip would be $1, right? The dollar value would now be $1 instead of 10 cents. It would now be $1 per pip. So therefore, if you won the trade, if you won the same 64 pips, then you'd have won $64 instead of $6.40. That sounds nice, but if you lost the trade with the same 32 pips, you would have lost $32, or 32% of your $100 trading capital, bringing your new trading capital to $68. All right, that is way too much, guys. You can't lose 32% on one trade. So yeah, in one trade, you'd have lost 32% with a lot size of 0.1. It would have taken 10 losing trades at your previous lot size of 0.01 to lose the same $32. So you can see how important that is to manage your lot size. Third scenario, quickly. If you had used a lot size of 0.3, which is 3 mini lots, pip dollar value would now be $3 per pip, all right? Winning the same 64 pips on the trade would have earned you $192 on that one trade, and you probably and bringing your account total to $292. Yippee! Yeah, wow! You'd be jumping for joy. You almost tripled your account in one trade. However, if you had lost the trade with 32 pips, you would have lost $96 and blown your trading account and have a balance of only $4. Congratulations. That's not the way we want to do it, guys. We don't want to be blowing accounts around here. You don't want to do that. I don't want you to do that. So manage your lot size, manage your risk. Okay? This is why proper risk management using the right lot size every time you enter a trade is so critical to your trading success or failure. It takes discipline to work with smaller profits, but don't try to double or triple your account in a couple of trades, guys. Take your time, follow a trading growth plan, do a spreadsheet, and compound your money daily or as often as you choose, okay? Final scenario, quickly. Now, if you had $500 instead of $100 in your trading account, then using the same 4% risk, you can now risk $20, up to $20 instead of just $4. Your PIP value would now be 20 divided by 32 equal to 0.625. So your lot size is now 0.06. If the same trade won 64 pips as above, it would now convert to 64 times 60 cents, $38.40. You'd have won $38.40, all right, instead of the previous smaller amounts. And your balance would now be $538.40. If you lost 32 pips, however, it would have equated to $19.20. So you'd have lost $19.20, bringing your account down to $480.80. Therefore, the larger your trade capital, the larger the amount of money you are prepared to put in your trade capital. By the way, guys, don't put more than you can afford to lose in your broker trading account. But the larger you can put in there, the larger your risk dollar value will be, with the same small percentage risk. In my example, 4%. And the larger your gains on winning trades will be as well. All right? This is an important takeaway, guys. Write this down. You must calculate your lot size before entering every single trade based on your current trade capital and your percentage risk that you decide on, okay? But do it consistently. This is a screenshot showing MetaTrader 4. I just did this mainly to show you where the lot size is. Depending on your broker, you might not see instant execution. You might see market execution. What you want to do is you want to basically set your lot size here. You don't want this one. This is a standard lot. When you multiply that by 10, that's $10 per pip. This is way too high. So you press these values here to decrease it, or you just type it in. So you're putting your lot size here. Where the red line is where you put your stop loss, and where the green line is where you put your take profit. And you hit the sell or the buy button, depending on what trade you're doing, okay? Fine. Okay, those of you who are taking the Tradera Trade Alert need to know the following. They do not give you an entry price, okay? They suggest that you enter the trade at the current market price as at when the alert comes out. So this is why if too much time passes, it may not make sense to enter the trade, guys. And the values I'm going to give you below may change and alter the outcome of the trade depending on the volatility of the market. That means how fast price is moving up or down, right? So if you're going to take the trade alert and you're a newbie, you're not going to do any analysis for yourself. Just jump in as soon as possible. 1 to 5 minutes is what I have here, but quite frankly, I want to jump in even quicker than that, within the first 2 minutes, because the market is volatile. Price will be moving quickly, and it's going to throw your winning pips out, and it's going to also change your stop loss if it starts going against you, all right? So as soon as possible, but mainly a profit. Not so much a stop loss, but mainly a profit. If you enter the trade alert after 10 minutes and price is really moving in that direction, instead of winning the amount of pips that you were supposed to win, you probably only end up winning 10 pips or less. All right, that's why I say you have to jump in quickly. Also, if price is going against you, yes, it can affect the stop loss, because if price is heading right down close to the stop loss, MetaTrader will not allow you to enter a stop loss that is too close to the current market price. All right, so you need to jump in the trade quickly. Second thing you need to know is that the stop loss that they have assigned is always 32 pips below the current market price that they expect you to enter the trade at. So you just have to multiply your lot size by 32 to know how much you stand to lose. Their stop loss is always 32 pips. The take profit levels are always as follows. They give you 3, they give you take profit 1, 2, and 3. Being 16, 64, and 160 pips. It varies slightly for take profit 3, but those are the set values that the Tradera Trade Alert give you, all right? So you can work out your lot sizes based on what you're going for. Another note for those people who are using the free Forex premium signals, their stop losses are not a fixed pip value like the 32 pip discussed above for Tradera. Therefore, the number of pip for each trade alert must be manually calculated, all right? They have already removed the pipette value from the stop loss and the take profit prices. So when they give out their trade alert, it does not have the 5th decimal value for the major and minor currencies, and for the Japanese currencies, it only has 2 places of decimal. They have already removed the pipette. So when you're calculating the PIP value or for the stop loss, do not drop the last digit, as it is not a pipette but rather a PIP. Okay. Number 3, their take profit levels are always take profit 1 is 20 pips, 2 50 pips, and 3 100 pips. That's what these signals go after. All right, so that's it, guys. I really hope this training sent a light bulb off in your heads, and you're all now clear on the concept of lots and pips, and most importantly, risk management via lot sizes. All right. If you don't remember nothing else, let this be your number 1 takeaway. Pay attention to your lot size. It will make or break you, okay? All right, well, if you like this video and it really did give you some value and understanding, I'll ask you kindly to go ahead and hit the like button below the video. Happy and prosperous trading. God bless. Keep safe. Until the next training. Peace.